I'd like to welcome everyone to the New York Alternative Investment Roundtable monthly call for April 2021. Actually, it's the second one we've done in April. I am Robert Atkinson of the Riverside Management Group, the moderator. And today we are very pleased to welcome two executives from RealBlocks, Perrin Quarshie and Scott Brooks. RealBlocks is an online platform that provides access and liquidity for alternative investments. It essentially democratizes access by lowering the required minimum investment amount, providing international access, and allowing for investor liquidity through secondary trading. Basically, a role provided by RealBlocks is to make it easier to own and exchange private securities, which I'm sure is a topic of interest to many folks on the call today. The title of their talk this afternoon will be Taking Advantage of the Rise of Alternatives in Retail. Just a word or two about our guests. Perrin Quarshie is founder and CEO of RealBlocks. Perrin began his career as a civil engineer at NAC International, where he focused on real estate development and finance of energy infrastructure projects. Following his stint at NAC, Perrin began graduate studies at MIT, during which time he conducted research on the implications of technology for the capital markets. Perrin next worked at Barclays as an associate in real estate investment banking, where he conducted M&A transactions for various REIT and private equity sponsors. Scott Brooks is Chief Operating Officer at RealBlocks and serves as CEO of the firm's FINRA registered broker-dealer and is president of RealBlocks Investment Advisors. Scott has over 30 years of investment management experience, leading distribution teams across both retail intermediary, defined contribution, and institutional channels. While working at some of the leading asset managers in the US, including CapView Partners, SEI Investments, DWS RREEF Real Estate, JP Morgan, AMG Funds, and Oppenheimer Funds, he is focused on the defined contribution, sub-advisory, OCIO, and high net worth markets, and is a recognized thought leader in each of these markets. He is responsible for raising over $35 billion in new assets for the firms he has worked for. So, gentlemen, it is terrific to have both of you join us today. Clearly, the world of private securities continues to be front and center, not only in the minds, but in the wallets of many investors. And clearly, the alternative investment market continues to grow. Now, the latest stat that I became aware of through our conversations offered up by Preqin was that the industry is growing by about $1 trillion a year and is expected to reach some 14 trillion in AUM by 2023, according to Preqin. Speaking for myself, I remember when it crossed the $1 billion threshold, and it's kind of hard to imagine it is where it is, but nevertheless it is. It's become increasingly global and just ever more important. And I think it's fair to say that this growth is especially evident in the retail space. So the need for solutions to offer access to this market while providing a safe environment will be essential for managers looking to grow their business. And of course, you gentlemen are going to touch on that. Now, before we dive into this very interesting topic and engage our guests, I do want to thank our sponsors for their ongoing support of the roundtable and this call. And of course, as you can see up on the screen, they include Alston & Bird, Baker Tilly, Bloomberg, who, by the way, Perrin just spoke on one of the news shows earlier this week, Deloitte, Grant Thornton, New Mountain Capital, Mirae Asset Securities, Prime Brokerage, and our nonprofit sponsors, Kaya, the United Kingdom Department of Trade, and the Grand Duchy of Luxembourg Trade and Investment Office. One final housekeeping note here, just as a reminder, these gentlemen will be answering my questions for about 45 or 50 minutes, and then we'll open it up to the audience. However, at any time during the call, you are able to send questions to me to give them by using the tools at the bottom right-hand corner of your screen. So by all means, please feel free to do so. One other programming note, please join us for the Roundtables Spring Cocktail Networking event, which will be this Thursday, April 29th, from 5:30 to 7. It's always a blast, and I think it really is a good networking event. So please do check our website for further details. So, gentlemen, let's get to it. Okay, Perrin, you're the founder. You're the CEO, or the co-founder, I should say. Let's lead off with you. What are you seeing as key growth areas for alternative investments in the coming decade? What are the key growth areas, Perrin? What are you seeing?
Sure. Thank you, Bob. So great to be here. So the key growth areas that we're seeing are basically looking at private real estate, private equity, and private credit. And what we are specifically seeing is interest in the retail channels. So the RIA, the independent broker-dealer, and the bank trust channels, which historically haven't had access. So those are the areas in which we are seeing the most growth. And what we're offering as a firm is a simple, an inexpensive, and a rapid way for the best and largest asset managers to get into this market by using our technology to be able to allow for that market to have access and to allow for the managers to expand their market share.
Interesting, very interesting. Scott, why don't you weigh in on that question as well, please?
Yeah, no, thank you, Bob, and a pleasure to be here as well. So yeah, what we're seeing in the marketplace, as we noted with Perrin here, that look, for a long time, pensions, endowments, foundations, all the institutional investors have had great access and exposure to private investments across all vehicle types and all sub-asset classes. But when you look in the broader retail marketplace, particularly in your high net worth segment, where they're grossly underexposed to alternative investments. In round numbers, the typical, pension plan may have 20 to 25% allocated to, private market investments. Your endowment and foundations, we all know the Yale model, with very high allocations, that may exist in that space. But when you look at the retail markets, and particularly in the high net worth segments, it's barely 5% today. They've traditionally been overexposed to public markets, what I'll call long only, whether it be mutual funds or SMA vehicles that exist in the marketplace. But again, bringing better access to those retail investors is one of our key value components here at RealBox.
And if I can, and I'll ask both of you to weigh in on this. What's an appropriate size manager for this program or this approach?
Sure. Yeah. So I'll go ahead and start. So basically, our technology is best suited for a manager that's looking to raise between 100 million to $500 million at minimum, in retail capital or in institutional capital. But basically, looking to do a capital raise for a particular vehicle, at least in the range of that size. And that can be scaled up to, the order of maybe $1 billion to $2 billion over time.
Okay. And how would you actually do that?
Sure. Yeah. So what we would do is, if a manager wishes to go, for example, let's say down market to retail investors, meaning independent broker-dealers or RIAs, or to small institutions like small teacher and firefighters pension plans, who often don't have good access to alternatives, they could use RealBox to create a sort of feeder that takes them that product down market. They could seed it with maybe 5-10% of what they plan to raise. And then we could basically connect them with distribution in the independent broker-dealer, RIA, or other institutional channels to go raise some capital there to start with. And then we could scale them up from there to larger institutions. So we give a nice sort of gradual, soup to nuts, simple way to get started, get some assets raised, grow that base, and then expand it.
Okay. And Scott, when people say what exactly do we mean by the retail market here?
Yeah, no, that's not always well understood. And, having spent a large portion of my career in that segment, there are a variety of subsegments that I want to point out for everyone to sort of level set here. Typically, one refers to the retail market as including intermediaries in the wirehouse channel, which is all your Merrill Lynch, UBS, Morgan Stanleys of the world. Then you get into the independent broker dealer segment, which includes groups like Raymond James, LPL, as examples. And then you get into the registered investment advisor segment, which is the fastest growing segment of the marketplace, which also coincides with a real move to away from commission-based transactions and more to an advisory fee. And again, not transaction focused, but again, a management fee based model that RIAs really were the beginnings of. And those are groups that trade through platforms like Charles Schwab and Fidelity as examples there. And many of these are large and emerging names like Hightower and others in this space here. So that's one of the key areas that we would encourage the group here to keep an eye on here as they continue to grow market share. And then finally, the bank trust marketplace. Obviously, the big boys such as J.P. Morgan in this space and others, and then down to some small, local and regional bank trust departments as well, continue to be strong players in the market and have a very similar business model to the RIA channel.
Okay, Perrin, any thoughts on this question?
Yeah, I mean, I think those are some examples there, and I'd say that one complexity is that getting down to this market, the large allocators typically write large checks, but the sales processes typically don't scale, and so one of the big problems is going to get all of these small tickets from these smaller RIAs and independent broker dealers is expensive, and it's time consuming, and it's a big headache for managers wishing to get into that market. And so what we've done is we've built the technology to aggregate all of those smaller investors so that they can quickly, simply, and easily get that capital into the manager's hand through our system as one LP. So that's one item I just wanted to emphasize there.
So Perrin, let me follow up with you on this. You keep on talking about ease of access. Yep. Let's use an example. Let's say we have a fund that has 20 LPs, okay? And if I understand you correctly, what you're saying is that RealBlocks would become an additional LP in that fund? Is that how it works?
Yes, yeah, that's exactly how it works.
Okay, and so from there, what happens?
Sure, so basically, initially at the outset, we'd talk to a manager and we'd say, okay, where are you distributing now? Where did your 20 LPs come from? And then they would let us know that, and we would carve that out, and we would say, okay, manager, we have this other market where we can bring you, an additional, say, as I mentioned, 100 to 500 million dollars of capital. And the nice thing about it is rather than you having to go and set up a feeder, set up a sales team, set up the fund administration, you can use RealBlocks, with one simple engagement, and we can set all of that up for you and get you that capital and service and manage the relationship with all those small investors so that it comes up to you as the manager as one LP. So that's really the convenience of not only having to use our system and being able to use our system to get set up and in market, but not having to deal with the headaches of onboarding, managing, servicing, and just having that come up as one LP. So that's the real advantage there.
So it almost sounds to me like a hybrid between fractional shares in the public market and an omnibus relationship whereby one of the LPs, namely RealBlocks, acts as an intermediary and in effect does all of the record keeping work, number one, or most of the record keeping work, or facilitates that process. And secondly, helps to facilitate the exchange of shares for money.
Yes. Yes, that's correct, Bob.
So as a result, it would make it easier for, let's say, high net worth investors to participate at a level that's, let's say, lower than would be otherwise expected. Number
Yes.
one, and number two, it may make it easier for the larger firms that Scott was referring to participate in these funds.
Right. That's correct. That's correct, Bob. So basically, it's we are expanding the distribution footprint for a manager. We are allowing for lower minimums on the investor side. And then we also allow for secondary trading of positions, because many of the smaller in the retail or high net worth spaces, many of those, the CIOs there are concerned about liquidity for clients. And a lot of the daily liquid funds can gate, for example. So the nice thing about RealBlocks is not only can we get higher quality product into the hands of those retail investors or those small institutions, we can bring down the cost and we can address the illiquidity with the built-in secondary trading functionality there that goes beyond what the manager has. So that trifecta there is really, really important. And that's sort of what we call the holy grail.
Yes, very interesting, very valuable. So Perrin, just to sort of sum up or to continue your thoughts on distribution, how do you see it changing in the United States right now? What
Sure.
direction is it taking?
Yes. So, distribution for one is taking a unique direction in that the technology component is being, demanded. So we live in a society where pretty much anything can be bought online with a few clicks, and having to fill out subdocs that take hours and hours and that come back with errors, and come back not in good order, and that require a lot of difficulty in completing on the side of the GP and the LP is a horrible experience that people are simply fed up with. And so we provide the technology needed to allow for scalable online cross-channel access so that we can eliminate those headaches and those friction points with getting people in to those investments. So I'd say that's one big area. The second is that, rather than, as Scott mentioned, meaningful allocations are around 20%, the retail market especially has around 5%. And, in this environment, prolonged low interest rate environment, people are wanting better, access to alternatives for yield. I mean, private credit has seen a lot of demand there. And so the market has spoken and wants better access. And so not only are we providing a better experience, but we're eliminating that bottleneck and providing the access and the lower cost. So, those are things that the market wants, and we've responded in that manner. And we're excited about being able to use that as a catalyst to advance the use of alternatives across retail and smaller institutions than has been the case in the past.
Oh, go ahead.
Go ahead, Scott. No, please.
Yeah, I was going to share a funny
I was
story.
just going to say that you're an experienced distribution pro, and I'd be curious to get your thoughts on how things are changing.
You just call me old. No,
Experience. I like experience.
Experienced, exactly. No, I was going to share a funny story from one of our large clients is a tier one private equity firm, and their CEO explaining how to sit down with one of his subdocuments with his lawyers at his own firm, that it took him hours to complete the subdocument. Now, if the CEO of his own firm, again, a tier one manager can't complete a subdoc in a timely fashion, how do you think the rest of the world feels? And that's where, again, the value of a technology platform to really streamline that and make it all online is of such value, whether it be to the financial advisor or the client, to accelerate that process and make it more mutual fund-like is really critical.
Yes, I completely agree. And gentlemen, one other question. Given the fact that the investor would be would the investor own what would the investor be owning a piece of? Is it a piece of ABC fund, or is it a piece of some other LP, the 21st LP that we described before in that example? How does this all work? And then I guess maybe secondly, does the requirement for the accredited investor requirement,
Yeah.
How is that impacted here? How does that weigh in?
Sure. Yeah. So what the investor is owning is they're owning shares of the underlying fund. So we create a feeder in our platform.
Okay.
And the feeder, it has a digital online access component, but they're owning shares of the feeder, which is dedicated solely to that fund. So, I mean, by virtue of which that's their ownership structure that we've set. So, that's the first item there, is that they're coming into our feeder and being able to get access to that underlying fund. And the second is that, when, they choose to invest, the statements, reporting, et cetera, are coming through our system. So they're getting all of that, and they're getting their dividend distributions, reporting, withholding, all of that done with our system. And then also the third item that's interesting is that foreign investors can also benefit from the enhanced tax savings associated with our levered blocker that we have. So those are the three components.
Okay. Fund managers all over the place really need to grow their business. I mean, there's no question about that. And I think that job is not any easier today than it once was. Do foreign markets present an opportunity for managers? And if so, how does Real Blocks fit into that?
Yeah, great question, Bob. So, I mean, there's about $1 trillion per year in alts that are sold in the US mainly. And, there is probably about $5 to $6 trillion of foreign demand. But accessing that is a real nightmare for managers, because they have to set up a sales team, set up a feeder and manage it, and set up the fund administration, which for KYC and all those components for foreign nationals is really a headache. So, one of our biggest clients, it's an asset manager with over 60 billion in AUM. They were able to use Real Blocks, and rather than taking the $2 million in 2 years to set up that feeder to get foreign access for their US only core real estate product, we got them up and running in about 2 months for about $70,000. And the initial KPI they set was to get $50 million of interest, and we brought in over $280 million of interest in 1 quarter. So that's probably the best success story that we have to show, the value that we can bring to managers who are in the US who want to tap into this growing demand.
Yes, and so, Perrin, what based on your experience, and Scott, by all means, please jump in here too. What makes US managers attractive to foreign investors? What have you seen? What are you seeing in the market?
Sure. Yeah, so I mean, a lot of the US managers are seeing the fact that, like, a lot of foreign nationals, especially in certain places, are sitting in literally fixed income because they just don't have access to alts because of the expense and time associated with US managers having to set up local sales teams. So, at the end of the day, in the US, it's a race to the bottom on fees. Things are becoming more saturated. Technology is allowing greater distribution in the US, and managers want to continue to grow their top line without having to fight, tooth and nail with all of their competitors. So an easy way to do that is to use a technology platform like ours to go and tap into these, uncharted foreign markets that literally have no access.
Yeah,
Scott, any thoughts?
Yeah, I was going to say, to go a little bit deeper on that. What we see is a lot of, and to echo some of Perrin's remarks, is that we see a lot of these investors overexposed, or have a real home country bias in their investments. And again, given the strong regulatory characteristics and still the perceived safe haven of the U.S. marketplace, that coupled with, again, this trend towards alternative investments, we're seeing extremely strong demand. And particularly in some geographies in the world, also, you've got a little bit of political unrest that's come to bear here, particularly with everything going on with COVID and political, pressures, et cetera. Here, there is a little bit of a safe haven going on in some countries where the U.S. is, again, does retain the title again as that safe haven here. So again, the confluence of those factors, again, we're seeing just great experience across geographies on an international basis.
Okay, and gentlemen, how do these investors think about alternative investments, and what are the key investment characteristics?
Sure. Okay, I can start, and Scott, feel free to chime in. There was a question about suitability, so just answering real quickly. I saw somebody asked. I mean, our platform allows for accredited investors, so 3C1 or 3C7, which is the QP product, to be bought, and we also allow for 40 Act funds to be created and distributed to non-accredited investors. So that's an important item there, is that we also address the suitability issue by allowing for omnibus positions to be bought by advised clients, thereby helping to bring the product more efficiently down market. And then to answer your question, Bob, about how investors think about alternatives, things like private real estate, they've all been familiar with and they all like the idea of, but even private credit, private equity, hedge funds, they've heard about and read about, but often don't have good access to. So they're knowledgeable from a theoretical standpoint, but it's the access that is the big problem. And that's what we solve with the tech.
Yes.
Yeah.
Scott?
Yeah, I was going to say, and one of the trends we're seeing is what we'll broadly define as the institutionalization of the retail marketplace. When I started my career at Oppenheimer Funds back in '89, right out of school, the retail market was, hey, what's your Lipper rating? What's your Morningstar rating? And if it's good, I'll sell it to my client. Whereas now you've got investment gatekeepers at all of these major bank institutions, broker dealers, et cetera. I'll tell you, some of the hardest investment committee meetings I've had have been in the broker dealer segment, not in the institutional segment. So, I think that's one of the areas of comfort, for many of the managers on the call here, is that, it's very similar, if not identical, to the process you're already following it in the retail marketplace. It's just, this sort of the same investment committee, but a different place is the way we like to think about it. So that institutionalization should make it easier for managers to really acclimate quickly.
Thank you, Scott. And gentlemen, we have another question in from the audience. And if this isn't proprietary information, by all means, please feel free to answer it. To date, how much capital have you either raised or helped to raise for the various stakeholders here?
Sure. Yeah, we can start with that. So for the first manager, as I mentioned, it's a U.S. real estate manager, very well known and very successful in the U.S. wirehouses. And they have some penetration in the independent broker and RIA space, but they didn't have any foreign, penetration. And so they were able to use RealBlocks to go and get their fund, distributed abroad. And, they had set a KPI for about $50 million. They'd call it a success. And we brought 280 million. So that's the first success story there. The second is a large asset manager. They have about $2 billion within a index fund. And they have basically raised that $2 billion of equity in the U.S. In the institutional space, they have good LPs like CalSTRS and Texas Teachers in it. What they didn't have was a retail footprint. So basically, we just started that one off, and in just about a month, the first month, we were able to get around 5 million to start, and that's growing very, very quickly. And after a first month of marketing, that's not a bad showing, and that's ramping up very, very quickly. So those are the first two success stories there.
Yes, congratulations. Scott, any further thoughts there, or?
Yeah, no, again, we've got such a great pipeline of, sort of tier 1 and tier 2 managers here, where, and again, to clarify, our business model is one where we work very closely with third-party placement agents and third-party marketing firms, depending on the channels and the geographies they're looking to connect with. We have relationships now with over 120 distributors globally here, that many of them have a long track record of raising billions of dollars in capital here. So while RealBlocks isn't specifically doing the distribution, we're connected with some of the best distributors here globally that we can put, using our platform and our technology, put in touch with these managers to create that immediate demand that's looked for.
Okay. And gentlemen, can you speak for a moment about the fees involved? How does that all work? Who's the customer? Who engages you? And what are the associated fees, the line items?
Sure. Yep. I mean, Scott, you want to start and I can tag on?
Yeah,
Or-
sure. We very much view the alternative investment manager, as our key client. And what we're looking to do is create the right solution for the right market at the right price. So whether you're looking at institutional market solutions or retail market solutions, the pricing for our product can, really cover all of the distribution costs, the fund setup costs. We typically will offer those at the fund level that's paid by the investors. So it becomes a very low cost exercise for the manager themselves. Typically for a one-time setup fee, that coupled with an AUM fee at the fund level that is paid by the investor here, we can create, very attractive cutting edge solutions here again, at a very low cost outside of the time, that the managers will spend on investment committee calls.
Yeah,
Yes.
yes. The kind of the way that works is the manager, an asset manager will hire us, we'll create a retail share class or a down market share class within our system. And, the base is the institutional share. The dealer manager fee is removed. We add an AUM fee at our level, which covers our costs for our software and our reporting. And the net to the investor is still very competitive with what's being sold through the big wirehouses. So just wanted to kind of add on to that at the end of the day, not only are we giving the manager a turnkey way to get into this new market, we're giving the client or the advised client at the end of the day, even with our fee added, still a good product at a very reasonable price.
Yes. And so, Perrin, what's the best way to improve liquidity in these investments without giving up the illiquidity premium that so many investors seek?
Yeah, great question, Bob. So, what our system, we have, it's set up to where we have our platform, we create a share class for a fund, distribute it. And the nice thing is that, the illiquidity premium is something we're all very aware of, but adding secondary trading functionality where we can allow for LPA to sell to LPB using our system, or to allow LPA to sell to a secondaries buyer within our system in a private dark pool peer-to-peer transaction. That we found to be the very best way to preserve the illiquidity premium, but still add liquidity beyond what the manager has in the underlying share class of the fund.
Scott?
Yeah, I was going to, and to add on to some of Perrin's remarks there, the buyer criteria that we see, particularly in the broad retail marketplace, is a little bit different than the institutional marketplace, where investors place, no pun intended, a much higher premium on liquidity and pricing, which we know that many of these investments historically have not had. So, using our platform again, we have the ability to provide enhanced liquidity, as Perrin had mentioned, through secondary dark pool trading to give what we like to call the escape hatch to that investor. If they need to get out for whatever reason, they want to buy a new house, et cetera, they do have an ability to get out. And we've got a great array of secondary managers and other, folks on the buy side, including the other LPs themselves that can actually participate in that secondary transaction to enhance that liquidity. And that coupled again with the other big objection in the marketplace, which is pricing. We've got a variety of valuation providers that we can work with in the products that we create to provide better valuation, whether it be daily valuation or quarterly valuation or monthly valuation, again, to meet the investor needs of the segments that we're approaching.
I think everyone on the call probably recognizes that technology is changing much of the way that business is done across industries. And that certainly can be said about financial markets, financial services. How do you see, Scott, this trend impacting alternative investments?
Yep. There's no question, that technology continues. We had talked earlier about the straight through processing. Then we talked about how we can enhance liquidity with secondary trading. And the way we do that is by digitally issuing the shares of the units in our, whether it be feeder funds or primary funds, that allows that tradability. So all of that coupled with the ability to tie together all of the service providers, into a very convenient, I love how Perrin, views us in aspiring to be the Amazon of alternative investments, to bring all of those service providers together in one platform for the investment manager to make it quicker, cheaper, and easier for that investor to get the exposures they're looking for.
Perrin, your thoughts?
Yeah, I mean, just kind of echoing what Scott has mentioned. I mean, at the end of the day, the market has strong demand for the product in an area in which they haven't had it before. And the market, based upon where we are in the tech life cycle, demands better tech. They demand a digital experience. They demand ease of use and ease of access. And also the liquidity issue, in terms of having more liquidity for their underlying investment. So having the technology to do that is going to make any manager who wishes to get into this market and wishes to stay better positioned.
And gentlemen, for the investor that goes into a program like this, how are their equity interests evidenced? I mean, in the public market, we have stock certificates, or actually we really don't touch stock certificates.
Yeah.
Right. In the private market, we do have stock certificates. They tend to be physical. So the digital world that you are referring to, or the move toward digitization here, how would that manifest itself?
Sure. Yeah, great question. So our system is what we call a hybrid system. So we have the digital experience online that makes it easy and simple for the user to get in and for the manager to distribute. And then we still have, as sort of what we call the training wheels approach, connectivity with traditional record keeping and transfer agency. So we have integrations with SS&C, and we have integrations with UMB and other transfer agents to handle the fund admin and TA components, so that the traditional record keeping and the functionalities for reporting that are required by the RIAs can still be undertaken. So that's the unique thing about our system, is we do have both of that.
Okay. And so, Perrin, I would just follow that question up with this one. Clearly, regulatory requirements have only been increasing across the spectrum, right? We can all attest to that.
Right.
But especially in the world of alternative investments. So is there any way to help mitigate the costs of complying with these new regulations?
Yes.
How does Roblox do that, or RealBlocks do that?
Yeah, great question, Bob. So, the cost of the regulation and the difficulty associated with it, especially when you go to foreign markets, is a huge barrier. And we've solved that with our technology, but for U.S. components, there's still responsibility on the broker dealer and RIA side. So what we've done is we've said, we're not only going to give you, the manager, a better technology with which to get out to market, but we also are going to give you access to our broker dealer and our RIA to handle all of those services for compliance. So we can fully give you an integrated solution that is regulatory compliant and that will decrease the administrative burden for you on an ongoing basis. And so that's what we're excited to deliver.
Okay, so let me ask you another follow-up here. A broker dealer has to be involved in this exchange. Is that the case?
Yes.
Correct.
Okay, so we talked before about the internationalization or the globalization of this business, right? So you might have investors outside the United States that want to have interests in US managers. Would that require the services of an offshore broker dealer? And
sure.
Okay, so how would you? So then you'd be responsible then for monitoring regulatory developments in various jurisdictions, right? I guess actually, in the jurisdiction the offshore broker dealer was
Yes.
resident.
Yeah, I
Yeah,
mean, sorry, go ahead, Scott. Oh, yeah.
I was just going to say, there's no question that we spend a lot of time with lawyers. We've got, some of the best counsel globally that we're working with, groups like Clifford Chance and Kerry Olson, Latham and Watkins, Morgan Lewis, just to name a few of the groups that we've been working with to make sure that we're fully compliant on a global basis. That coupled with that, we're also working with some of the largest financial institutions around the globe to make sure that we've got all of the facility, whether it be a U.S. broker-dealer or an offshore broker-dealer, to remain fully compliant with, particularly, we touched on the secondary market transaction piece,
Yes.
make sure that we're fully compliant within the private fund universe for those vehicles.
Yeah, and so just putting a finer point on that, that Scott had made, big problems associated with like compliance locally. Like a lot of people want to get to Europe, you have to set up an AIF there or an AIFM for hire. And we actually at RealBlocks have that functionality to do all that for the managers. So it's not only it's tech, it's we have relationships with many of the best law firms, who can also address this compliance component for geographic compliance in foreign markets, which is a big nightmare, and that we're solving as well for the managers.
So Perrin, given the difficulty in accessing new markets experienced by fund managers, how important do you think it is to establish strong partnerships in these regions, or these countries, or these regions?
Yeah, it's extremely important, and in fact, it's the only way to operate compliantly and efficiently. So, the nice thing is that it's not only but partnerships, but it's also about having the technology to make the process scalable. And so, the partnerships, many firms, many large managers have started to establish partnerships, but what they haven't done is they haven't established the technology. So that first manager that I mentioned, whose initial core real estate product we took to a foreign market, they were so impressed and excited by the technology that we built that even though they have a strong business selling to sovereign wealth funds, pension funds, insurance companies globally, they didn't have tech. And they decided to white label our technology to use it across their entire $63 billion business. So the proof is in the pudding right there, in that not only are managers seeing value in the distribution piece, but also from the standpoint of how our technology or this technology could expand their ability to do their existing businesses much better.
Okay. Scott, your thoughts?
No, I would completely echo Perrin's thoughts there. The largest firms in the business, whether it be on the institutional side or their emerging retail businesses, this lack of technology is absolutely pervasive. We're feeling very fortunate to have such a great platform. I mean, when I met Perrin and the team 2 years ago, I joked with them that I saw all the missing pieces, having run distribution at some of the largest managers in the country here in the alternative space. Again, all the missing pieces that weren't at those large firms, so much as the mid and small size firms. It's been a great pleasure. And we see just great opportunity to simplify the business, making a better client experience across both the institutional and retail segments of the business here.
So we talked a little bit about partnerships around the world, but what about partnerships when it comes to, let's say, working with capital placement professionals, prime brokers, other members of the alternative investment ecosystem? Because it sounds to me like what you're proposing, or what you are actually offering right now, is an open architected solution. So talk about that for a second, Scott. How can a capital placement professional work with you?
Yeah, no, that's a great question. And as I had mentioned earlier, we have relationships with over 120 placement agents and third-party marketing firms. We've got such demand in terms of managers that we want to have a large array, and always interested in meeting new, whether it be innovative or traditional placement agents, to understand their specialty, whether it be by asset class, geography, or sub-market segment, whether it be retail or institutional, et cetera, to really understand their business, what their value is that they bring, so that when we meet managers, we like to essentially play the matchmaker between the two groups. So again, bringing the right distribution resource to the right manager is one of the key value propositions that we bring at RealBlocks. So placement agents, et cetera, are a key part of our partnership ecosystem.
let's do a real life or a fictional example, hypothetical example here.
Yeah.
So a capital placement professional associated with a broker dealer is representing a small manager, and that small manager is, let's say, somewhere between being small and emerging, whatever that really means in dollars and cents, AUM size.
Yep.
Outstanding track record, great strategy, et cetera, et cetera. That type of a situation would be of interest to you.
Absolutely. Absolutely. Yeah, we like to think that we've got all the, front, middle, and back office, and we think of front office as being the distribution. So in the case you just mentioned there, where the broker dealer is doing the placement agent work, great. So then we can do the middle and back office piece with all of the onboarding automation and all of the connectivity and product construction. So again, bringing to the table, working with that placement agent and that asset manager to create the right product, whether it be a feeder fund solution, a multi-fund solution, if it's down market and creating a tender offer 40 Act fund solution. Again, we can create pretty much any product needed to be most effective and most cost effective at raising capital with that placement agent.
So in that situation, Perrin, you would be evaluating the manager based on performance and other attributes, such as, for example, would you be looking at operational due diligence? Is that on your?
Oh, go ahead, please, Bob. Please finish.
I was just going to say, is that something that you look at? In other words, you look at the manager in his or her totality before making an introduction to, let's say, a wirehouse or to an RIA for distribution?
Yes, we look at the manager completely before making an introduction to any of the distribution partners, because we realize that the distribution partners are going to want vetted managers that have strong track records and strong operating capabilities.
So you have a team of professionals that are looking at these managers, both in terms of the alpha they might generate, as well as their business acumen.
Very much so, yes. Interesting.
And where do you see the growth right now for you? Is it with, and Perrin, I think you mentioned this earlier, that it was managers who had, I think, $500 million and up, or several hundred million and up. Did I get that right?
Yes, that's correct. Yes, several managers who have several hundred million and up who want to get a product to a new market, be it down market US retail or down market US institutions, or even foreign retail or foreign institutions. But managers who are wanting to use us to break the barriers with the tech that we've set up, so that we can get them selling more of their product in more locations.
And given the breadth of services that you offer, it seems that not only might investors find this interesting, I'm talking about retail investors, but the companies that are looking to distribute the product, because you're out there surveying, I would imagine, hundreds, if not thousands, of managers, right, to assess their application with your distribution channel. Is that an accurate statement?
Yes, very much so.
And how do you source these managers?
Sure. So a lot of them come from, the league tables, and we look at, their success on the in various areas like private equity, private credit, et cetera, and hedge funds. But starting with the league tables and going, or actually what we call, which is the push-pull scenario, or going actually to our distribution partners and asking them who they want access to. So that's kind of what we call the inbound scenario. So we use both continuously,
yes,
to sort of match make.
Scott, your thoughts on this?
Yeah, no, the other thing I was going to add, we've just got a tremendous advisory board at RealBlocks. The members of our advisory board have, in similar fashion, worked for some of the largest asset managers in the country. Groups like Blackstone, the old Evergreen funds, AllianceBernstein, just to name a few. So again, some of the biggest managers represented. So In many cases, our advisory board has just been a great source of referrals for some of these top shelf managers. That coupled with, Perrin and I and some of the members of our team also have great connectivity across these different managers over the years. So the confluence of all that has been great, but we're always open for, additional referrals as well. So by no means do they have to be referred in, but that tends to be a great starting point.
Okay. And gentlemen, we have a question here in from the audience regarding DC markets and the changes there, and as well as the Department of Labor letter. Any thoughts on that, Perrin?
Sure. Yeah. So we actually have been working as a firm very closely with Groom Law, who penned that letter, and we were mentioned in Plan Sponsor magazine for afterwards. And the reason why is because our technology presents a unique opportunity to allow for the creation and distribution of DC product by handling the onboarding component, handling the daily valuation component, and handling the trading that would be needed by the consultant or OCIO. So, basically we have an advantage in creating DC product for target date funds, target risk, or collective trust. So we actually have several DC initiatives in play with many of the large consultants, and we'd be happy to help your audience members learn how to look at that opportunity and think more about how it will impact their business, as that's going to be a very large and growing market segment.
Yes. Scott,
Yeah.
would you like to comment on that?
Definitely. I'll joke with you. We were on a call with Groom Law Group a few weeks ago, talking about litigation in the DC market, which has slowed the adoption of alternative investments, among other things. That's sort of the bad news. But we were joking the other day that we're seeing the tables starting to turn where we may actually see another lawsuit type come up where maybe plan participants will actually start suing plan sponsors for not using alternative investments in their defined contribution plans.
Yeah.
Now, for those of you that aren't familiar with the marketplace, and let me tell you as backdrop, I was one of the founders of the Defined Contribution Real Estate Council, as well as the Defined Contribution Alternative Investment Association. So I've spent a good portion of my career in this segment as well. And one of the things that's really important to understand is that DC plans are really becoming much like pension plans, which is not well understood. The way that's happening is through something called target date funds, which many of you may be investing in today in your own company 401k plans, which have come to dominate the investment landscape. So without going into great detail, target date funds are really just pension plans that are divided up into 10 age-specific pieces that have an underlying asset allocation that's professionally managed, just like a pension plan. The big thing missing is alternative investments. And there's some really cutting-edge plan sponsors that do things called custom target date funds, which are frequently managed by large investment consultants in their OCIO business. And groups like Verizon and others have used private investments and hedge fund investments for years, very successfully within those plans. So now with, again, the continuing trend in terms of the regulatory environment, we touched on the DOL letter last year that said it is reasonable to invest in private equity, and therefore private investments and hedge fund investments are reasonable. So now you're seeing the DOL starting to support this. And there's some action in the legislative, with Secure 2.0 and the rise of things called, multiple employer plans, now called PEPs, which are the consolidation of a lot of little plans into a big plan. So what we're doing is really following a path similar to what was seen in Australia, where they went from every corporation having their own DC plan to there's roughly 50 superannuation funds down there. We're on that same path. And that's going to make it a more institutional environment and allow the use of alternative investments. And that's something that RealBlocks can also help with in terms of vehicle construction, daily valuation, as well as the enhanced liquidity.
Interesting, very interesting, Scott. Gentlemen, another question in from the audience, and it has to do with fees. How are fees impacted by the role played by real blocks in creating that last sleeve, that liquid sleeve for real blocks? Are there any benefits to the investor there?
Yeah, absolutely. So I can start with that one. So let's look at the example of that core real estate product that we distributed abroad for the first time. And currently it's distributed, through the big wires like Morgan Stanley today.
Yes.
And what we did is we were able to take an institutional share class of that fund and use our technology, and we stripped out the dealer manager fees, and we were able to put our fees on and the placement agent's fees and the investor servicing fees and come in lower and cheaper than the closest competing share class offered by Morgan Stanley. So, our goal is, and we were successful with this first manager on this, is to bring international distribution across every channel in at the same price that investors in the market is used to seeing in the US. So for managers, it's almost like a why not use real blocks, because you can get all of that foreign sales capacity basically for free.
Interesting. Scott, any thoughts there?
I could only echo his remarks and say, we basically took a U.S. product and are delivering it more cheaply to foreign investors than it's available here in the U.S. Right.
And gentlemen, another question in from the audience. Are you seeing do you receive mandates with respect to strategies?
Yes, we actually.
Are you seeing any theme to demand there?
Sure. I mean, yeah, we actually have a mandate that we're working on now for a credit fund, a BDC that we're taking to Europe. We have some mandates around private real estate products. We have some other mandates that managers are bringing to us with specific goals around locations and share classes and items that they want to create, either single manager product, fund-to-fund product, or multi-manager fund-to-fund product. So those are a couple of those that we're seeing.
Thank you. Scott, anything to add there?
Yeah, yield is king. So if you've got a top performing product with a good yield that can beat treasuries and or your local bonds, that wins all day and all night. So yeah, whether it be through equities that are yield generating or fixed income investments on the private side, hedge fund investment, etc. Yield is king.
You can say that. You can say that. So, gentlemen, we're coming up on the end of our time here, and I just wanted to know if you had any parting thoughts for the audience. And Perrin, I'm going to ask you to lead, please.
Sure. No, I'd say that, thank you for the time. It's been great to speak with you. And at the end of the day, we look forward to helping you create the best alternative investing experience for investors and managers worldwide. And we'd love to work with all of you in helping you guys tap into, using our tech, this growing demand that we're seeing down market in the US and abroad.
And I know we discussed this on one or more occasions. So you have a sense as to the diversity of the audience here at the roundtable. Who should be reaching out to you? Managers, prime brokers, capital placement professionals, technologists.
Right.
Who?
I'd say all of the above, honestly, as our tech could provide utility to everyone.
Terrific. Scott, any parting thoughts?
No. As new members of the New York Alternative Investment Roundtable, we're really happy to be part of such a vibrant group here. And to echo our tagline, we're looking forward to building a better alternative with you guys. So really appreciate the time here today.
Well, and I just, on behalf of the roundtable, want to thank Perrin Quarshie and Scott Brooks of Real Blocks for joining us. This whole move toward facilitating the buying and selling of private investments is a new frontier, a very important one. And we look forward to more conversations with you. And I hope to see both of you at our networking event, the Spring Cocktail Party, on Thursday night at 5:30, between 5:30 and 7. But on that note, I again want to thank you, gentlemen. I think it was very informative, and I would encourage members of the audience to reach out to both Perrin and Scott, and you can see, I guess we have some contact information up on the screen. We'll leave it up for a second, but do want to thank you both. It was very informative, very interesting.